Welcome back to Talk Tickers. Today is Friday, February 13th, 2026. And honestly, if you were a bear in this market yesterday looking at the ticker tape, you probably feel like Friday the 13th came a day early.
Oh, yeah. A day early and with a vengeance.
We are looking at a sea of red for the shorts and just a massive green candle for one specific company.
A huge one.
We are diving deep into Crocs Inc., ticker symbol CROX.
And when you say massive green candle, it wasn't just a tick up, it was a resurrection.
That is a strong word, but looking at the chart, I don't know how else you describe it.
I mean, really?
The stock didn't just move, it ripped.
Yeah.
We were talking about a close yesterday at $98.46.
Right.
That is up over 19% in a single trading session. For a mature retailer, that's seismic.
It's absolutely seismic. And I think it was the relief rally of the year so far, certainly for the consumer discretionary sector.
Relief, that's the key word, isn't it?
It is. Relief is the operative word here. This wasn't a rally based on, everything is perfect, growth is exploding.
Yeah.
It was a rally based on, we aren't dead.
Exactly. And we have to set the scene here because the narrative going into this print was, let's call it apocalyptic, to be polite.
It's a good word for it.
Yeah.
Yeah. The bears were out in full force on this name.
You had fears of the HEYDUDE acquisition basically imploding.
Right. That it was a complete and total failure.
You had people screaming about tariff headwinds crushing their margins.
And the short interest was elevated. The sentiment was just incredibly negative.
So the market was pricing in what? Exactly. A total disaster.
A total disaster. They were pricing in a big guidance cut, a collapse in margins, and, potentially a confession from management that the HEYDUDE deal was a mistake.
A write-down waiting to happen.
A write-down waiting to happen, exactly.
And instead...
What did we get?
Instead, we got a masterclass in execution. And, look, it wasn't a perfect quarter.
Far from it. Far from it. But it was a better-than-feared quarter. And in this market environment, better than feared, combined with strong cash flow execution, that's rocket fuel.
It's the perfect recipe for a short squeeze.
100%.
So that's the mission for today. We're going to unpack this earnings report. We're going to look at why the street was so wrong.
Yeah, where is the disconnect?
We're going to dig into the hidden gems in this report because it is not just about rubber clogs anymore, not by a long shot.
No, we're talking about a stealth growth story in China, which is fascinating.
A massive buyback program and I'd call it a surgical cleanup of a really messed up acquisition.
And we have to talk about the mechanics of that cleanup. Because if you just read the headlines, they're going to miss the actual strategy. It looks terrible on the surface.
It looks like a disaster. Absolutely.
Yeah.
So buckle up. We're going to break down the numbers, the strategy, and then, of course, the trade.
All right, let's do it. Let's start with the results snapshot.
Okay, let's hit the headline numbers first. The beat, as they call it. Adjusted EPS earnings per share came in at $2.29.
$2.29. And the street, what were they looking for?
They were looking for somewhere around $1.91.
Okay, stop there for a second. That is a massive beat.
It's huge.
We are talking about a roughly 20% beat on the bottom line. For a mature retail company, a 20% EPS beat it's virtually unheard of.
Right.
Unless something dramatic happens with, tax rates or some weird one-time item. This suggests a fundamental disconnect between what the analysts thought the business could earn and what the CFO actually delivered.
And the top line, too, revenue came in at $958 million.
Okay.
Against an expectation of about $916 million. So they beat there as well.
So a beat on the top and a blowout on the bottom.
But here's the kicker, and I want you to explain this because it sounds completely contradictory.
Okay.
They beat the revenue expectations, but the reported revenue was actually down 3.2% year over year. How does that work?
Right. And this is where context is king. The revenue is down on a reported basis, primarily because they are deliberately, intentionally shrinking the wholesale channel for HEYDUDE.
We're going to get to that.
We'll get into that deeply later, but that's the reason. The beat happened because the consumer demand, the actual direct demand from customers, was stronger than what the analysts had modeled.
So the analysts thought the consumer was just walking away entirely.
Exactly. They thought the brand was dead. But the numbers show the consumer is still there, even if the retailers are destocking their shelves.
Okay, so it wasn't a volume story then. They aren't selling more shoes than last year.
Not in total pairs. No, not when you factor in that wholesale pullback. It was a margin management and tax rate story. coupled with just extreme discipline on expenses.
Okay.
So even though the growth margins took a hit, and we knew that was coming because of tariffs,
Right, that was the big fear.
they managed the operating line so tightly that the profit just flowed right through to the bottom. This is what we call defending the bottom line. And they did it beautifully.
Okay, let's talk about the guidance. Because usually a stock pops 19% because they raise the roof on future guidance. They come out and say, we're going to grow 20% next year.
Right, some blowout guide.
But looking at the numbers for 2026, it looks, I don't know, fine, just okay.
Fine is the perfect word. And fine was all they needed.
Really?
Absolutely. For Q1 2026, they are guiding revenue down about 3.5 to 5.5%.
See, that sounds bad.
And for the full year, they're seeing revenue flat to slightly down, maybe -1% to slightly positive.
That doesn't sound like a rally. To me, that sounds like stagnation.
It does if you look at it in a vacuum, but you have to remember what the market was pricing in. The whisper number, the number traders were actually betting on, was probably down 5 to 10%.
Oh, wow.
So when the market is terrified of a revenue collapse and management comes out and says, no, we're going to be flat, we're holding the line,
Yeah.
that feels like a massive victory.
It's all about expectations.
It's all about expectations. But the real juice, the real kicker, was in the EPS guidance.
Okay.
They guided $12.88 to $13.35 for the full year 2026.
Which was above expectations.
Significantly above, way above what anyone was modeling. And that signals that even with flat sales, this company is printing cash.
An efficiency machine.
It's becoming an efficiency machine. And that divergence, flat sales but rising EPS, that's what caused the squeeze. It tells investors, we don't need massive growth to make you rich. We just need to be efficient and buy back our stock.
Okay, so the headline is, we aren't dying, and in fact, we're actually getting much more profitable per share.
That's the perfect summary.
So let's dive into the actual businesses, because Crocs Inc. is really a tale of two very different brands right now.
It is. It's also a tale of two geographies, which is maybe even more important.
Let's start with the namesake then, the Crocs brand. If you live in the US, you might think Crocs are kind of everywhere, maybe too everywhere. Is the fad finally fading here?
Well, the idea of North American maturity is real. The data absolutely backs that up.
Okay.
Crocs brand North America was down 7.4% in Q4.
Wow.
That is a significant pullback.
Yeah.
And if that was the only data point you had, you would be right to be worried. That's a scary number.
Down 7% is a lot for what's supposed to be a growth stock.
It would be catastrophic if that was the only story. But here is the pivot, and this is the reason the stock is up 19%.
Okay.
International was up 14.1%.
That is a huge delta, a 20-point swing.
It's the narrative shift we have been waiting for. For years, Crocs was a U.S. growth story. It was about selling clogs to Americans in the suburbs.
Right.
Now, it is a global export. And management said this explicitly on the call. In 2026, the international business is projected to be larger than the North American business.
That is a massive milestone. I mean, we're flipping the script entirely. It's not an American shoe sold abroad anymore.
No.
It's a global shoe that just happened to start in America.
Precisely. And we have to talk about China, because that is where the real anomaly is.
Oh, the China numbers.
Mm-hmm.
I honestly had to double check this because I didn't believe it at first.
It's pretty incredible.
In a macro environment where you hear Nike is struggling in China, Apple's having issues, luxury brands are issuing profit warnings.
Everyone is worried about the Chinese consumer. They're supposedly tapped out.
Right. And Crocs revenue in China grew 30% in 2025. 30.
It is fascinating. And you have to ask the question, why? Why is the Chinese consumer, who is supposedly suffering from a property crisis and deflationary pressure, why are they buying Crocs?
Is it just the price point? Are they that cheap?
It's the intersection of price and status. It's what we call affordable luxury or accessible status.
Explain that.
Okay, so a pair of Crocs, especially the lined ones or one of the collaboration models, it isn't cheap in a discount sense, right? It's not a $5 knockoff.
No, they can be 60, 70 bucks.
Yeah. Exactly. But it is affordable compared to a $200 pair of Jordans or a $500 luxury sneaker.
So it's the lipstick effect.
Yeah.
When people feel poor, they stop buying houses, but they'll buy a premium lipstick to feel good.
Or in this case, premium foam. That's exactly it.
Yeah.
And it fits the whole tangping or lying flat culture in China right now.
Oh, that's interesting.
There's a rejection of that high stress, high status rat race. The Croc represents comfort, self-expression, and a little bit of irony.
Right.
It says, I'm opting out of the hard leather shoes and the corporate ladder. I'm choosing comfort.
Lying flat in your Crocs. I love that. That's a great narrative. And it's not just China driving this, right? The international story is broader.
Oh no, it's broad-based. Western Europe posted double-digit growth. Japan returned to growth. This is a real sustainable international expansion. The brand heat is traveling.
Okay, let's talk about the product itself, because every time I go out, I see the clog. It's always the clog. Is there a risk that they are a one-trick pony? That this is all just one shoe?
The clog is the iPhone of this company. Let's be clear about that.
Okay.
It's 74% of the mix. It is the engine. But what's interesting is how they are iterating on it. They aren't just selling the same foam shoe over and over again.
They mentioned the crafted clog on the call. What exactly is that?
Right. So this is their attempt to move upmarket and broaden the usage occasions. The crafted clog uses different materializations on the upper.
Like fabrics.
Fabrics, textures, weaves, all on top of that same molded sole. It makes it look less like a garden shoe and more like a casual loafer or even a fashion piece.
So it extends the season. You can wear it in the fall. You can wear it in places where just plain plastic might feel a little weird.
Exactly. It captures a different wearing occasion, as they say in the industry. And then there's the sandal strategy.
This is the sleeper hit.
This is the sleeper hit. Sandals are now 13% of the mix. That is a $450 million business.
Just the sandal.
Just the sandals. That's bigger than many standalone shoe companies.
That's incredible.
And they took market share in North America. While the overall footwear market was soft, Crocs sandals actually grew.
What are they pushing there?
They're pushing the Echo franchise expansion and this new two-strap sandal. They are basically coming for Birkenstock's lunch.
But at a much more accessible price point.
And with a margin profile that is very, very hard to beat.
Right. The molding.
Molded footwear injection molding is incredibly profitable. You pour the resin in, you pop the shoe out. It's so much cheaper than stitching leather and rubber together.
We can't talk about Crocs without talking about the marketing. I mean, these guys are the kings of the weird collaboration.
They understand the meme economy better than any other apparel brand out there. They lean into the ugly. It's their superpower.
They specifically shouted out the Lego partnership.
Launched at Paris Fashion Week, no less.
Which is just hilarious in itself. A Lego Croc at Paris Fashion Week.
But it fits perfectly, doesn't it? Both brands are about modularity, color, play. The brick clog, it's ridiculous, and you know it will sell out instantly.
Oh, in seconds. And they mentioned the Twilight collaboration.
That was a specific call out by the CEO, Andrew Reese. He mentioned the Twilight Crocs are reselling for 3 times MSRP on the secondary market.
That is the definition of brand heat. When your $50 plastic shoe is flipping like a limited edition sneaker, you are culturally relevant.
And all of that drives the Jibbitz business.
The little charms.
Jibbitz grew to 8% of sales. Just stop and think about that for a second. 8% of a nearly $4 billion company is little plastic charms that you stick in the holes.
That is pure, unadulterated margin. That is just printing money.
It's incredibly high margin, and it locks the consumer in. Once you have a collection of charms, you need the shoes to put them on. It's a platform strategy, essentially.
A canvas for self-expression.
That's their line, canvases for self-expression. And it's working.
Okay, so the Crocs brand is the steady ship. It's the international growth engine paying the bills.
Right.
Now we have to go to the dark side. We have to talk about HEYDUDE.
The problem child. The reason the stock was so beaten down?
The numbers were ugly. There is no sugarcoating this. HEYDUDE, revenue down 16.9% in Q4.
Which is bad.
But wholesale specifically was down 40.5%. 40%.
Yeah.
If I just saw that headline, wholesale down 40%, I would think the brand is dead. I would think retailers are fleeing a sinking ship.
And on the surface, it looks like a complete disaster. It looks like the retailers have rejected the brand and are sending everything back.
Right.
But this is where you have to listen to what management is actually doing, not just the headline result. This is an intentional controlled burn.
But wait, explain that. Why would you intentionally drop revenue by 40%? That sounds like corporate spin to cover up a massive failure.
It sounds like spin, I get it. But the logic actually holds up. Here's the reality. The channel was stuffed.
Too much inventory.
Way too much. In 2022 and 2023, there was so much inventory shoved down the throats of retailers. Dick's Sporting Goods, Academy, the family footwear channel.
So the shoes were just sitting there.
They were sitting there getting marked down, ending up on clearance racks, and that kills brand equity. It cheapens the brand.
It makes it look like a discount brand, not a cool, comfortable shoe.
Exactly. So management said, stop. They just stopped shipping. They pulled back $45 million in revenue.
They literally took returns.
Taking returns or just intentionally not shipping orders to fix those inventory levels. They call it cleaning up the channel or fixing the gray market.
So they are taking the pain now, missing out on all those sales, to save the brand's health for later.
Precisely. And if you look closely at the data they provided, the glut is gone. Retailer inventory levels are finally at parity with sellout rates.
What does that mean, parity?
It means for every pair that a retailer is now receiving, a pair is being sold to a customer. The system is in balance again. That is a healthy ecosystem.
And there was one stat that really stood out to me that proves this wasn't a consumer rejection.
Let me guess. DTC.
DTC. While wholesale collapsed 40%, direct-to-consumer, their own website, was flat to slightly up.
That is the single most important data point in the entire HEYDUDE section of the report.
Why?
Because if the brand was truly dead, DTC would be down 20 or 30% too. The fact that customers are still proactively going to HEYDUDE.com and buying the shoes means the demand exists. The wholesale drop is purely a supply chain correction.
So that gives credence to their green shoots narrative.
It completely validates the strategy. The consumer still wants the product. The retailers were just overstocked.
So what's the pivot? You can't just shrink forever. When do they turn this thing around?
Management explicitly guided for a return to growth in the second half of 2026.
The back half of the year?
This is the show me part of the story. They're basically saying, trust us, Q1 and Q2 will still look ugly because we are lapping the old bad habits from last year. But by Q3, we grow again.
And are they just going to sell the same shoes? Because part of the problem was it was just the Wally and the Wendy over and over.
No, they know they can't survive on just two silhouettes. Andrew Reese, the CEO, he pitched the New Jersey launch.
I loved his tagline for this.
It was great. He called it a t-shirt for your feet.
A t-shirt for your feet. It immediately tells you what it is. It sounds comfortable.
It's smart marketing. It plays to the core strength of the brand, lightweight comfort. And they're also moving into the H2O program, water shoes and work shoes.
Work shoes make so much sense for HEYDUDE.
Yeah.
I mean, if you were on your feet all day, a nurse, a server, or someone in a warehouse, you want something light.
Exactly. And the marketing is pivoting too. You're going to see this Hey Dude Country campaign.
Okay.
They're focusing on that core laid-back male consumer. They aren't trying to be high fashion. They're trying to be the comfortable shoe for the guy who's fishing or grilling or just hanging out.
So, to use an analogy, HEYDUDE is in rehab.
Yeah.
The doctors say the prognosis is good, but the patient is still in the hospital for the first half of the year.
That's a perfect analogy. And the market is now willing to wait for the patient to recover because the Crocs brand is paying all the hospital bills in the meantime.
Let's talk about those bills. Segment 3, the profitability engine. Because despite all this messiness with HEYDUDE, they are generating a ton of cash. But there is a huge elephant in the room.
The tariff elephant.
Tariffs.
We knew it was coming. Gross margins fell to 54.7%. That's down 320 basis points. That is a big, big hit.
And that's primarily tariffs, not markdowns.
A large chunk of it, yes. Tariffs and freight costs. And the guidance suggests it actually gets worse before it gets better.
Right.
They expect an 80 basis point headwind for the full year 2026, but it's all front-loaded.
How bad is it in the first half?
Q1 will see a 100 basis point hit to margins. Q2 will see a 200 basis point hit.
Ouch. So Q2 is going to be the pinch point. That's where the headlines might look ugly again.
It is. But here's the magic trick. And this is what the market loved. Despite this massive gross margin pressure, they are guiding for expanding operating margins for the full year.
Okay, wait. How do you do that? How do you make more money when your cost of goods goes up that much?
You cut everything else. You get absolutely ruthless with efficiency.
The $100 million cost cut.
That's the one. Management identified $100 million in savings. It's coming from supply chain modernization, organizational simplification.
Which is usually code for layoffs.
It usually means headcount reduction or streamlining corporate structures, yes. And general efficiency.
They mentioned AI, of course. Everybody has to mention AI on an earnings call now.
They did, but I thought they were refreshingly honest and realistic about it.
How so?
They aren't claiming AI is some magic bullet that's going to reinvent the company. They said they're using it in marketing and product creation as an efficiency tool.
So doing more with fewer people.
Or doing it faster. It's an operational tool, not some visionary strategy.
Yeah.
And it helps them find those savings.
So they cut costs to offset the tariffs. It's a wash. But the real story for shareholders, the reason the EPS guide was so high, is what they did with the cash they're generating.
The buyback machine. This is why the stock is up 19%. This is the whole story right here.
Give me the numbers.
Okay. They generated $659 million in free cash flow in fiscal year 25.
A huge number.
And they used almost all of it. They bought back 6.5 million shares for $577 million.
Now, contextualize that. What does 6.5 million shares mean for a company this size?
It means they retired approximately 10% of the entire company. 10% of the float. Gone. In 1 year.
That is stunningly aggressive.
It is incredibly aggressive. When you shrink the denominator, the number of shares outstanding, your earnings per share goes up automatically, even if your net income stays completely flat.
So that's how they bridged the gap. That's why the EPS beat was so big and the guide is so high.
It's financial engineering, but it's brilliant financial engineering. They are creating shareholder value through brute force cash deployment.
And they aren't over-leveraged? They aren't putting the company at risk to do this?
No, not at all. They're at the low end of their own debt target, between 1.5 times leverage. They have a pristine balance sheet, massive cash flow, and they are buying their own stock hand over fist because they believe it's fundamentally undervalued.
And clearly, after yesterday, the market is starting to agree with them.
Violently agree with them, I'd say.
Which brings us to the investor context. Let's zoom out. Why did the stock jump 19% on what was essentially a flat revenue guide?
It feels like a massive re-rating.
It is. The stock was priced for a bankruptcy-level failure of the HEYDUDE brand. It was trading at a PE multiple in the single digits, which suggested earnings were going to collapse.
A value trap, people thought.
Right. And now
it's being repriced as a stable cash flow cow. The market is saying, okay, even if HEYDUDE never grows again and just stays flat, the Crocs brand growth plus those buybacks make this a double-digit return stock. The risk premium is just evaporating.
management talked about the bifurcated consumer on the call. I thought this was a really interesting macro point.
It's the macro theme of the year, right? The low-end consumer is broke, or at least very tentative.
Feeling the pinch from inflation.
Right. But the high-end consumer is still spending. They're fine.
And usually a retailer has to pick a side. You're either Walmart or you're Neiman Marcus.
Exactly. But Crocs sits in this perfect sweet spot. We call it the barbell strategy.
Explain the barbell.
They are cheap enough for the low-end consumer to trade down to. If you can't afford a new pair of Nikes, you buy a pair of Crocs. But they're also trendy enough thanks to the collabs and that whole ugly cool factor for the high-end consumer to buy them as a fashion statement.
So they win on both sides of the bifurcation.
They capture both ends of the market. It's a very resilient model in this environment.
It's still a show me story though, right?
Yeah.
The second half of 2026 is everything.
The entire bullish thesis rests on H2. Investors are taking a leap of faith. They're trusting management that the HEYDUDE growth will return in Q3 and Q4.
And if they miss that?
If they miss that, the stock gives back a lot of these gains.
There was a great moment on the Q&A when an analyst tried to ask about the fall order book.
Yeah, trying to get a sneak peek.
Trying to get a little clue about that Q3 recovery. And management just shut them down. Refused to comment.
Which is standard practice. You don't guide that far out. But it adds to the risk. Visibility is still pretty low. We're flying on instruments here, and we're just trusting the pilot.
But compared to their peers, they look like geniuses.
I mean, look around. Nike is struggling in China. Crocs is growing 30% there. Other retailers are drowning in inventory. Crocs is turning its inventory more than 4 times per year, which is best in class. They are objectively executing better than the rest of the sector.
Okay, so we have a stock that just popped 19%. We have a management team that is aggressive on buybacks. We have a turnaround story in HEYDUDE that is still TBD. What do we do with this? It is time for our favorite segment.
Disclaimer time.
This is not financial advice.
Not at all.
We are two voices on a podcast. We are not your financial advisors. Please do not trade based on what we say.
We are just brainstorming wild ideas. We're having fun with the thesis, like a hedge fund pod on a Friday afternoon.
All right, hit me. What's the trade?
Okay, I call this one the H2 2026 Hail Mary. Or maybe the calendar spread of fate.
A calendar spread. Okay, I like it. Break it down.
The thesis is simple. The first half of this year, H1 is going to be noisy and maybe a little ugly.
Right.
You have the big tariff hits in Q1 and Q2 that we talked about. You have HEYDUDE revenue still showing negative year-over-year comps because of the cleanup. The headlines might get scary again.
So the stock might stall out here, or even dip as people take profits after a 19% run.
Exactly. But management has staked their reputation on that second half, the H2 recovery. So the trade is a calendar spread.
Okay, walk us through the mechanics of that.
You sell out-of-the-money calls for June 2026. You're basically betting the stock doesn't skyrocket in the next 4 months because of all that tariff noise.
Yeah.
You collect the premium from those options.
So you take the cash from the pessimists, or maybe the impatient optimists.
And you use that cash to buy aggressive, further out-of-the-money calls for January 2027.
Ah, I see. So you're financing your long-term bet on the recovery with the short-term pessimism.
You're getting paid to wait for the turnaround. If Andrew Reese is right and that T-shirt for your feet takes off in Q3 and the China growth holds up and the buybacks continue, those January calls are going to print.
That's a sharp trade. It aligns perfectly with the guidance cadence they laid out. What else you got? One more.
I have a pair trade. I call this one plastic versus leather.
Plastic versus leather. Simple. I like it.
The thesis is even simpler. The consumer is broke, leather is expensive, foam is cheap.
Okay, I'm with you so far.
We're seeing a clear trade-down effect across the economy. So the trade is you go long, CROX, the plastic king,
Right.
and you go short a high-end leather boot manufacturer or a Western wear proxy, something like a Boot Barn or a luxury leather goods play that's really exposed to that strained U.S. consumer.
That's interesting. So you are betting that the guy who used to buy a $300 pair of leather boots is now buying a $60 pair of HEYDUDEs or Crocs work shoes to save money.
Exactly. It's a recession hedge. If the economy gets worse, Crocs should outperform leather. If the economy gets better, well, Crocs likely still keeps its new customers, but the leather guys might still struggle with higher input costs. It's an interesting setup.
That is a savage trade on the state of the American consumer, but the logic is sound.
It's just playing the macro trend.
All right, let's bring it home. Conclusion time. Let's recap this thing.
Recap. Crocs delivered a masterclass in expectations management. They lowered the bar, easily stepped over it, and then casually announced they bought back 10% of the company while doing it.
International growth is carrying the team. The China story is real, it's not a fluke, and it is huge.
HEYDUDE is in rehab. It's a painful process, but the inventory cleanup is absolutely the right long-term move for the brand's health.
And cash flow is king. They are shrinking the share count so aggressively that it's providing a massive floor for the earnings per share number.
That's the bottom line. It's a cash flow story now.
Okay, one final thought to leave you with. This is kind of a fun factoid they dropped on the call. Management celebrated their 20th year as a public company this week.
20 years.
Do you know what their total return has been over those 2 decades?
I saw the number. It's pretty impressive.
700%. That is almost 2 times the return of the S&P 500 over the same period.
Wow.
So this is not a flash in the pan. This is not some fad. This is a company that has survived being called a fad for 2 decades. They are aggressive, they're decisive, and they just squeeze the shorts into oblivion.
The lesson is never bet against the clog.
Keep your clogs in sport mode, everyone. We'll see you at the next bell.